Sonal Varma, first conversation this morning, Managing Director and Chief Economist, India and Asia ex-Japan at Nomura, with us this morning. Sonal, pleasure as always to speak with you, and thank you so much. I think great time to get your perspective with everything happening. As the Trump trade seems to be receding quickly and maybe disappearing, what does this mean for emerging markets, especially India?
Well, it's a extremely tough period because if the US does go ahead and implement the various tariffs that it's promising to on 2nd of April, which is something as a house we think is likely to get implemented, then from an economic perspective for the US, we are likely to see weakness in growth. We think it's going to be a year of below trend growth and higher inflation as the tariffs kick in. So that stagflationary kind of a backdrop actually ties the Fed's hands in terms of what they can do. And as you all were discussing, the US administration is also ready to take some short-term pain for what they believe is going to be a medium-term benefit for the US economy. For EMs in that backdrop is essentially, much weaker growth. We think disinflation is likely to still happen because higher tariffs on China does mean the risk of more dumping of those excess products in other countries. But then we also need to basically be ready for more volatility in terms of financial markets, in terms of more capital outflows, currency spillovers, which typically do have feedback loop back into consumers through the wealth effect and businesses because of uncertainty. So essentially, weak growth and more volatility is what it all means.
Right. So Sonal, when you talk about this kind of uncertainty and volatility, the kind of shifts that will happen in supply chain as well, right? And you're looking at the geopolitical alignments. How do you see India on it? Because clearly there could be some bit of benefits that could come in. So overall, what could they be, number one? And two, its direct impact in terms of the GDP.
Well, the direct GDP impact is actually going to be visible over the next 3 to 5 years. I think in the next 12 months, actually, we will see more of the negative impact of weaker growth, weaker global growth showing up. So I think the medium-term benefits in terms of India gaining on world export market share of specific products where supply chains are moving away from, let's say, China, will be a benefit. Now, specifically on the supply chain shift, the focus of the Trump administration is one, to bring some of the supply chains in strategic products back to the US, and they are also looking to bring about more of a strategic decoupling from China. Now, on the latter is where we think India is likely to continue to benefit. Over the last 5-6 years of trade tensions, India did benefit on electronics, but actually Vietnam has been a big beneficiary in the first round of trade tensions. This time around, the Trump administration is looking to also close the loopholes that were used by firms to bypass China tariffs. And the analysis basically shows that some parts of Southeast Asia and Mexico have benefited from circumvention of China tariffs. So as those loopholes are closed, we think the supply chains will move to newer destinations, and India, which is a strategic ally India, which is a strategic ally of the US, should benefit from the new round of supply chain shift. So electronics, smartphone is one, but we need to think about the other components of the electronics ecosystem. We can move up the value chain. So we do think that in the non-strategic low to mid-tech manufacturing sector, where there is space to compete, India should be a benefit. But like I said, the benefit will reflect in the next 3 to 5 years. The next 6 to 12 months, it's still the global spillovers we need to navigate.
Sonal, morning, Neeraj here. How well does India navigate these pressures through internal policies? Because the one thing that we've seen in the last couple of months, at least, is this this whole monetary easing that the Reserve Bank of India has embarked upon, some budget benefits that the government has given as well, does that help alleviate the pressures to an extent that we get back to the normal 6.5% average? Or could that be under question mark if indeed the US slips into the recession?
I mean, yeah, absolutely. If the US slips into recession, then 6.5% will not be feasible. So I think we'll cross that bridge when it comes. But currently, as you said, when global growth is slowing down, it is important for countries like India to undertake countercyclical policies in order to buoy domestic demand to the extent that we can. To offset the weakness in global demand. So the policy mix we have seen in the last 2 months or so does show that there is a recognition that growth in India is already below trend. Inflation is close to the target already, in our view. And therefore, a more coordinated approach on countercyclical policies is the need of the hour. So, and I would say we are seeing that already in terms of the budget focus on consumption, the rate cut, the liquidity easing, which has surprised positively. And of course, the macroprudential easing that the Reserve Bank of India has begun. Now, it takes time for the policies to show up in terms of economic growth, but the countercyclical adjustment has started. On our own forecast, we are expecting FY26 GDP growth at around 6%. On a relative basis, I think, when we look at rest of Asia, which is, very open, export-oriented, the potential risk to growth there would be a lot more substantial relative to India, which is more domestic demand-driven. So this counter-cyclical policy is important, needed. But just one more thing is for emerging markets, we need to strike the right balance on supporting growth without going down the path of macro imprudence. I don't think we have seen that in India. We are actually doing all the right things in terms of focusing on some of the medium-term reforms, giving some counter-cyclical policy to ensure that some of the negative offset from global factors is supported through the domestic demand trigger. So things are still cycling down on growth, but I think we're moving in the right direction on policy front.
Can I just ask Sonal you a question on that? Because a lot of people out here are now trying to think of how is it that global investors are thinking about India on the flows front. I am trying to understand from you, how are people thinking about the policies that India is doing? Because you'll be talking to a lot of investors on that front, right? The fact that there's a large economy, yes, went through a growth slowdown, hopefully we'll get back on the growth path, other things remaining constant in the US. At the same time, doing or obeying fiscal prudence in a meaningful way, is that a big feather in the cap or not really? Because we don't see other economies doing that. I mean, Germany is being rewarded for getting on a path of really unbridled fiscal spending, which they haven't done for ages, right? So I'm just trying to understand, how are people thinking about India on the policy front?
Yeah, I mean, Germany fiscal finances were in a very different situation, very low deficit, very low debt. Whereas for India, as an emerging market, our debt, the starting point on debt to GDP, public debt to GDP and deficits are higher. So I think, of course, the evaluation of Germany versus India is very different. So the context is very different. Now, specifically on investors and India, I think there's definitely a positive view in terms of policy making, particularly the countercyclical policy approaches we are starting to see. But I think investors are still looking for more confidence that growth is indeed bottoming out. While the headline GDP numbers, were better in the December quarter, the high frequency data, even until February for the auto sector, GST collections don't actually give that confidence that the worst is behind us on growth, particularly in the global context, also looking more negative now. So I think there's a need to see a true bottoming out on the domestic growth front. But I think now it's really the global uncertainty and global factors which have taken over. And the two things that are essentially in focus, one is this US India bilateral trade agreement, to what extent India, which has been, spotted out as one with higher tariffs and non-tariff barriers, to what extent we can actually strike a deal and not be, subjected to higher reciprocal tariff from the US. So there's a lot of focus on that. And second, on these supply chain shifts, this tends to be a more slow-moving change. But I think incrementally in sectors like electronics, there does seem to be a lot of scope for more medium-term growth actually coming through, despite these short-term turbulences. So I think near-term, there's still a bit of caution. Medium term, it's I would say people are looking for when would be the right point to be back in India. And obviously, we need to look at all of this in the context of what's happening in China, where there has been investor interest that has come back on the back of the tech rally there.
Yeah, absolutely. Thank you so much for your time this morning. Sonal Varma, they're laying out the lay of the land, which I think is a tough thing to do right now.